Okay, let's unpack this. If you own a home in Colorado, something fundamental is changing, and it's not the price of your house. It's the cost to protect it. We're seeing this profound structural shift. Insurance premiums are just exploding, and in some places, coverage is just vanishing.
It really is. I mean, the cost of being well-informed right now is critical. For years, the big conversation in Colorado real estate was all about appreciation, right? How much home values were going up.
Absolutely.
Well, the new crisis is the cost to actually ensure that appreciation. So for this deep dive, we're looking at what we're calling a trifecta of pain. You've got climate risk, economic inflation, and insurers just retreating. It's creating these red zones across the state and forcing Colorado to build a safety net, really a last resort.
And the data we're starting with is genuinely shocking. Colorado has, it's become the sixth costliest state in the entire country for homeowners insurance.
Sixth. And to put numbers on that, we're talking about average annual premiums for, say, $300,000 in coverage of around $4,000, sometimes a little more.
$4,000. And the national average is, half that?
Almost exactly. The national average is somewhere between $2,100 and $2,300. So we're nearly double. But, the most alarming thing isn't even the price tag itself. It's how fast we got here.
Exactly. This didn't creep up. It just exploded. We've seen analyses showing premium hikes of an average of 58% since 2018. Some data even shows a 77% hike.
That speed, that velocity is the key. I mean, look at local inflation. The Denver CPI, which tracks consumer prices, was up maybe 18–19% in that same time frame.
So insurance costs are inflating at 3, maybe 4 times the rate of everything else.
Right. That tells you immediately this isn't normal inflation. This is a market it's fundamentally restructuring itself around risk.
And here's where it gets really interesting for me. Why is this happening? If these companies are in the business of pricing risk and collecting premiums, why are they losing so much money that they're actually retreating from a growing market?
It comes down to profitability, or, well, the lack of it. The Colorado homeowners multi-peril market has just been hemorrhaging cash. We're talking about consistent, chronic underwriting losses.
How bad are we talking?
Between 2013 and 2022, the industry had an underwriting loss of 18.6%.
Whoa, wait, so for every $1 they collected in premiums, they were paying out about $1.18 in claims and expenses.
$1.18. That's right.
I mean, if I ran my business losing 18 cents on every dollar, I'd be bankrupt. How do they stay solvent?
That's a great question, and it really explains the retreat. Insurers are highly regulated, but they also have massive investment portfolios. They make money not just from your premium, but from the interest and dividends they earn on the cash they hold before paying a claim. For a long time, those investment returns could basically subsidize the losses from claims. But now, with claims costs skyrocketing from climate and inflation, those returns just can't cover the gap anymore. The losses are too big, too consistent. They have to fix the underwriting problem. And that means either huge rate hikes or, as we're seeing, pulling out of risky areas entirely.
That makes perfect sense. The math just has to work again. So let's dig into that claims side, the financial weight. We're calling it the trifold threat. And I think the number one driver is going to surprise a lot of people.
I think it will. When you say insurance risk in Colorado, everyone's mind immediately jumps to wildfire. And wildfire is absolutely a huge strategic threat. But the undisputed financial heavyweight, the thing that drives the most claims and costs the most over time, is hail.
So wait, we all remember the tragedy of the Marshall Fire, the devastation. But you're saying financially, hail is the bigger burden for insurers.
It is. Hailstorms account for somewhere between 50 and 60% of Colorado's total insurance claims volume. It's just relentless. It's often these smaller, localized events that just rack up billions in damage to roofs and siding over the years.
Wow.
And you can see this in the data. You look at a county like Logan County. It's not a wildfire hotspot, but it has some of the highest average premiums in the state, upwards of $5,000, almost $6,000 a year. That's almost entirely driven by the frequency of destructive hail.
That is a fascinating distinction. You've got the high-frequency, high-cost hail driving the raw numbers versus the high-severity, low-frequency wildfire that's driving the strategic fear.
Exactly. Wildfire changed the underwriting map. Colorado has, I think the number is over 320,000 homes at moderate or higher wildfire risk. That's $141 billion in potential reconstruction costs.
And the Marshall Fire was the tipping point.
It was the tipping point. Because it wasn't a remote forest fire, it was a grass fire that became an urban inferno, wiping out neighborhoods in densely populated suburban areas, right outside Boulder. That one event completely redefined how insurers see risk in the entire wildland-urban interface.
Okay, so we have the climate risks, hail and fire.
Mm.
But you mentioned a trifold threat.
Yeah.
What other economic factors are just pouring fuel on this fire?
Well, there are three big ones. First is just general high inflation. When a home is damaged, the cost to replace the structure, the cost of lumber, labor, roofing,
Yeah.
it's all way more expensive than it was even 2 years ago. So every claim payout is exponentially larger than what was budgeted for.
Right. And the second one is a bit technical, but so important. Reinsurance. Can you just break that down for us?
Absolutely. Think of reinsurance as insurance for insurance companies. Your local insurer can't afford to pay out, say, $5 billion after a catastrophe like the Marshall Fire all on its own. So they buy their own coverage from these massive global reinsurers. But when those global companies see more billion-dollar disasters happening everywhere, Florida, California, and now Colorado, they raise their prices a lot.
And so that enormous cost just gets passed right back down to the homeowner in Colorado.
Precisely. And then there's a third factor, social inflation. That's a newer term, but it's powerful. It's not about the price of materials. It's about the rising number of lawsuits against insurance companies and the really high liability payouts that come from those cases. That legal pressure just adds another layer of strain.
So they're getting hit from every possible angle. It's no wonder they're pulling back. So we've laid out the financial pain. Let's look at where that pain is actually showing up on a map. You said it's not a statewide exodus.
Not yet. But carriers are getting surgical. They're creating what the insurance commissioner calls these little pockets of unavailability.
We can see that in the numbers, right?
Oh, clearly. Data from late 2022 showed 76% of insurance carrier groups wrote fewer policies that year, and a big chunk of them, about a third, cut their volume by over 10%. So they aren't packing up and leaving Denver, but they are drawing very, very precise lines on the map.
And those lines are mostly around the WI, the wildland-urban interface, and the foothills corridor. These are becoming the red zones. For anyone listening who isn't familiar, can you just paint a picture of what a WUI area looks like?
Sure. The WUI is basically where suburban sprawl bumps right up against the natural environment. Think of beautiful, high-value land, cul-de-sacs that back up directly to scrub oak, pine forests, or high prairie grasslands. It's where the danger isn't some distant forest fire. It's a fire that can jump from the landscape right into a neighborhood.
And these red zones are hitting some pretty prominent communities.
Absolutely. Boulder County is ground zero, in a way. Specific zip codes like 80302, 80303. We're hearing from homeowners there who are just being dropped completely. And here's the really frustrating part for them. Some are getting non-renewed, even when they have a certified zero fire risk score on their actual property.
Just because of the zip code.
Just because of the zip code's proximity to a high-risk zone, the insurers are painting with a really broad brush.
And this is just crushing specific households.
Yeah.
We've seen these stories, like a computer engineer in Boulder whose rates nearly quadrupled,
Mm.
or a homeowner in unincorporated Boulder County.
Yeah.
Their policy went from about $4,900 to $7,900 in 1 year.
A $3,000 jump. I mean, that's a massive sudden hit to your monthly budget. And this is spreading. We saw State Farm stop writing new business in parts of Durango and near Purgatory Resort last year. Agents in places like Evergreen, Conifer, Estes Park. They're now actively telling clients not to move into the foothills because it's so hard to get any coverage at all.
That's an availability crisis. Plain and simple. So, what does this all mean? What's the state doing?
It seems like they're responding on two fronts. First, create a safety net, and second, demand more transparency.
That's right. The first response is that safety net, the FAIR plan. Fair access to insurance requirements. It was signed into law in 2023 and should be up and running for homes in the spring of 2025. This is strictly an insurer of last resort.
Okay, so you can't just choose the FAIR plan. You have to qualify. What's the threshold?
It's a very high bar. It is only for people who have exhausted every other option. You have to show proof of rejection from at least 3 different standard insurance companies. You literally have to prove no one else will cover you.
And if you do qualify, what kind of policy are you even getting?
And that's the critical warning for everyone listening.
Right.
Fair plan policies they're bare bones. They are often more expensive, and here's the key. They generally only cover the actual cash value ACV of the home, not the replacement cost. And residential coverage is capped at $750,000. That distinction actual cash value versus replacement cost, that might be the scariest part of this whole conversation. For anyone who hasn't had to deal with this, what is the difference?
Replacement cost means the insurer pays what it actually costs to rebuild your home, brand new today, even if lumber prices have doubled. Actual cash value, on the other hand, is that replacement cost minus depreciation. So if your roof is 15 years old, they calculate its depreciated value. After a total loss, you get a check for that low number, and the rest of the cost to rebuild comes right out of your own pocket.
And we know from the Marshall Fire what that means. 74% of the victims there were underinsured. So the FAIR plan, while it's necessary, it seems like it could just institutionalize underinsurance for the highest risk people.
Exactly. The FAIR plan solves the availability problem, but it does not solve the affordability problem or the underinsurance problem. If you live in a $1 million home in the WUI, a $750,000 ACV policy is a ticking time bomb.
Okay, so that brings us to the state's second approach, trying to force long-term risk reduction through transparency and mitigation. That's HB 1182, right?
Yes. HB 1182, the transparency bill, is all about solving the black box problem of risk scores. It doesn't fully kick in until July 2026, but its goal is huge. It mandates that insurers have to tell homeowners exactly what specific steps, what mitigation efforts will actually result in lower premiums.
So if I spend $10,000 to put on a fire-resistant roof, my insurer can't just hide behind some secret algorithm anymore. They have to show me the discount I earned.
That's precisely the goal. It makes mitigation an investment with a real, tangible financial return. The bill also creates a formal appeals process. Homeowners can submit evidence of their mitigation work to challenge their risk scores. State officials are basically saying, if your models aren't rewarding people for making their homes safer, your models are broken.
This entire situation, it really sounds like Colorado's insurance market is finally pricing in the full, undeniable cost of risk. This is just the new normal.
That's the perfect way to put it. The days of artificially low premiums, subsidized by investments or based on outdated risk models, those days are over. Insurers are now applying rates that are aligned with the real-world dangers of hail and wildfire, and homeowners have to adjust.
So for you, the homeowner who's trying to navigate all this, being hyper-informed about your policy has never been more important. You absolutely have to know your deductibles. Look for specific wind, hail, or wildfire deductibles. They can be thousands of dollars higher than your standard one. And start prioritizing those mitigation efforts. It's really your only long-term leverage.
And here's a final thought to leave you with. The FAIR plan is designed to be a temporary bridge back to the private market. But given how fast climate risk is accelerating, and the fact that these major risk bands run right alongside Denver, Colorado Springs, Fort Collins, how long until this insurer of last resort stops being temporary? How long until it becomes the main insurance market for anyone in the WUI? And what would that concentration of risk do to the financial stability of the entire state?
Colorado homeowners face different risks than most people realize. If you'd like a local, practical review of your policy, there's a free option linked below. And if you want to stay informed as things change, we'd encourage you to keep watching the channel.